Investing is the art of turning $1 into $2 or $100,000 into $200,000, not by going to work to get paid, but by buying the right assets with your money without going to the casino or DraftKings. But to become a successful investor and to see millions in your investment portfolio, even if you don't have a lot of money to start, you need to know the difference between an asset and a liability. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. When I go out and buy clothes, that's a liability. When I go on a vacation, that's a liability. When I buy a car, that's a liability. But when I buy stocks, I'm buying them to make money. It's putting money in my pocket. When I buy a rental property, it's putting money in my pocket every single month. When I buy dividend-paying ETFs, it's putting money in my pocket every 3 months. These are things that I'm buying for the sole purpose of making money, and they're putting money in my pocket. Ideally, every month or every 3 months or every year, there's money being deposited into my account, or the value of this investment is going up. That is an asset. A liability is something that keeps eating my money but isn't giving me any return. The mistake that many people make is we want to be rich. And what does it mean to be rich? It means wearing fancy clothes, driving around in a nice car, and living in a big home. So people then want to become rich, and then they go deep into debt, financing the Gucci wardrobe, the Louis Vuitton wardrobe, financing the BMW, and getting this big grand home, and then they have no money to buy stocks, they have no money to buy rental properties, they have no money to buy businesses, but they have all these nice things. You look rich, but you're really only rich in liabilities, and all of your money is going out. You have to keep going to work to get paid and to pay your bills. Versus an actually wealthy person who spends their money not to look rich first, but they spend their money to buy the rental properties, spend their money buying the stocks, they spend their money buying businesses, they spend their money buying other assets that pay them. In the beginning, it's very slow, but you have nothing to show for it. You can't show off your stock portfolio like you can a Gucci belt. You can't show off your rental portfolio the way you can a BMW. But slowly your investments start to go up in value. Slowly they start to pay you more money. And then 10 years down the line, now you have a whole portfolio of assets that can buy you the BMW without you having to go to work to make the payments. You have the assets that are paying you the money to fund your car. And now it's not your hard work that's paying for the car. It's your money that your money made that's paying for the car. When you buy assets, you're working to make money off your money. When you're buying liabilities, you're working hard to buy those liabilities. And what I want you to do is work hard to buy the assets first, and then let the assets pay for the liabilities. Buy whatever nice stuff that you want, but when your assets are paying for it, now it's your money that's working hard to buy it for you, and you worked hard to buy the assets. That's how you build wealth. Well, how do you actually make that happen? That's what I'm going to break down for you in this video step by step into 5 parts. So if you stick with me until the end, you'll know exactly how to put your money to work. That way you can start building wealth, building these assets. That way you can work to hopefully one day live off of the money that your money makes instead of just working a job to get paid, because you're never going to build wealth when you do that. Starting with number 1, building an investing plan. Before you think about which assets you want to buy, you have to know what type of investor you want to be. More specifically, do you want to be more of a passive investor or an active investor? An active investor is somebody who wants to spend more time, more effort, more energy, and more research actually building and finding this investment. Maybe this means going and looking for rental properties. Maybe this means researching individual companies. Maybe this means looking for businesses to buy. You want to put in the actual work, the legwork, to find the investment and manage your investments. A passive investment is where you don't want to have to spend the time and effort and energy keeping up with it and managing your investments. Once you find the investment, you just want to put some money in and you don't want to have to think about it. It's more of a set it and forget it type of strategy. This is for some people, and you have to know where you want to start. So if you like the idea of being a set it and forget it investor, you don't want to go and try to find the next Tesla, the next Nvidia, the next Amazon, because now you're taking on all the risk. You have to then keep up with Amazon. You have to keep up with the company, their earnings, their financials, what the CEO is doing, what innovations they're doing, because now you want to actually make sure that your company is not on the verge of bankruptcy. Because if Amazon goes bankrupt and you're invested in that one company, you lose everything. But if Amazon were to make a lot of money, well, now you also gain. So more risk, more return to be an active investor versus being a passive investor. Now the alternative is investing your money into funds. A fund is a basket of stocks. So an ETF, a mutual fund, and an index fund are 3 different types of baskets of stocks. This is where now instead of investing in one company, like say Amazon, you're investing in 500 companies, which includes Amazon and Apple and Nvidia and Tesla and McDonald's and Coca-Cola and on and on and on. That way now if one company goes bankrupt, you're okay because you have hundreds of other companies in there. Now, I'm not going to go over the differences between an ETF, mutual fund, and index fund in this video. I've already made a video going over that, which I'll link for you down in the description. But the whole idea here is now you don't have to worry about trying to manage the fund. There are fund managers that are doing all that work, and now you set it and forget it. You just keep automatically buying one of these funds. Now, in the real estate space, you can also be a passive investor. You could be investing into syndicate real estate deals or crowd-funded real estate deals. A syndicate deal is now somebody is building an apartment complex and they need money to do so. So you can go and invest $5,000 or $500,000 into this deal and you don't have to worry about doing any of the work. You give your money to the developer or the investor, they give you a piece of ownership and they're managing the entire deal. But you get your share of profits. You get your share of rental income or appreciation. However they're doing the payouts, you get your share without having to do any of the work because you are one of the investors in a syndicate deal. The alternative to that would be investing in crowd-funded real estate deals, which are very similar, but now you're investing into something primarily on the internet where an investor or a developer is looking to raise money from a lot of different investors, and then they'll take the pool of cash and go out and invest in a real estate project, and you'll get your share of appreciation, rental income, and everything in between, and you don't have to worry about unclogging toilets or dealing with tenants. The whole idea behind this type of passive investing is you're not actively managing your investments, you're investing your money, and then somebody else is doing the management, so it's more passive on your side. You can compare that to being an active investor where you are the manager of your investments. So if you want to invest in individual companies, you want to actually research those companies and manage the investments that you're making. That's how you invest in stocks. Or if you want to invest in real estate, now you are actually going out and finding the rental properties, whether it's apartment complexes, single family homes, office buildings, industrial buildings. You're going out and actually finding these deals. Now you don't have to be the manager, but you're actually finding the deal. You're putting the team together. You're hiring the property manager. You know who the contractors are, and you are the manager of the deal, not necessarily the property, but you are the manager of the deal. Compare that to investing in a business. There's a lot of people that are in the business of buying businesses, selling businesses, and owning the businesses. Not necessarily working in the business, but buying a business, whether it's a coin laundry or a laundromat or a vending machine business. The whole idea now is you're going out and buying the businesses, but ideally not working in the business, and that's how you're allocating your capital. You can also invest in startups, kind of like Shark Tank. There's a lot of platforms on the internet that will allow you to invest in startups, or you can even look at investing in commodities, something like silver or gold or oil. This is another way that you can invest your money as well. This takes more time, more effort, more energy, but you also have more return for more potential risk. This is less time, less effort, less energy, but less risk for less potential return. Once you understand your investing plan, the next question that you have to ask is, how do you want to get paid? By the way, for those of you that are investors or want to become investors, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we break down what's happening in things like the economy, the stock market, the housing market, crypto, and the global economy into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning. Plus, when you join Market Briefs, you'll also get our investing masterclass free as a bonus just for joining Market Briefs. So if you want to get Market Briefs and our investing masterclass all for free, all you have to do is click the link down in the description below to join. So now that you understand the differences between an active investor and a passive investor, you want to know the different ways that you can get paid, because you can get paid through cash flow or you can get paid through appreciation. Cash flow is when you invest your money into this thing, and then this thing is going to work to pay you money every month, every 3 months, maybe every year, as a distribution, as a profit share, as a dividend, as a rental income distribution that you get for just owning the asset. Appreciation is you buy this thing and then you hope it goes up in value, and that's how you get paid. So for example, if we go down the list, when you invest in an ETF or a mutual fund or index fund, you're investing in stocks. Some companies are not going to have any profits because they're going to want to distribute all the profits back into the company to grow as fast as possible, because they want to just gain their market share. They want to grow really fast. They want to take their stock price from $100 to $200 to $2,000. When you're in that game, what you're working for is appreciation, because the stocks are taking all of their extra money and they're throwing it back into the company to grow as fast as possible, as big as possible. That's what appreciation is. Some companies, on the other hand, are going to be much bigger, much more cash heavy, and instead of reinvesting all that money back into the business, they're just going to give some of it away to their shareholders. They're just going to give it away to their owners. And that is called a dividend. Some companies pay out dividends. These are generally the older, more mature companies that have the big profits, and they just give it away to the investors in the company. So if you own one share, one stock in a company that pays a dividend, you get payments every quarter, meaning every 3 months for doing nothing except owning that stock. And there are funds, there are ETFs, there are mutual funds, and there are index funds that specialize in dividend paying companies. So you can get paid here through dividends, through cash flow, which pays you every 3 months, or you can also work to get paid through appreciation. Here, when we talk about real estate deals, generally, when you're investing in real estate, the goal with real estate investing is cash flow, that you buy this property and then this property is going to pay you every single month through rental income. But sometimes there'll be exceptions where investors are in the business of building an apartment complex and then selling it for a big profit or doing a flip on a deal. So depending on how the deal is structured, you want to know, is it primarily for cash flow or is it mainly for appreciation? On the other end, with active investing, it's the exact same thing with stocks like we just talked about. You can get paid through cash flow with dividends or appreciation if the stock goes up. With real estate, the goal is primarily cash flow. When you invest in a business, this is also going to vary. Some businesses, especially startup businesses, are going to be in the industry of just trying to grow their value. They're not going to have profits and they're not going to want profits because they're just trying to grow their market share. They're trying to grow very fast. Other businesses are more cash flow businesses where they're not trying to grow super big. They're just trying to make big profits every month. That way they can be cash cows for you, the owner. Or commodities generally don't pay cash flow. The goal is to generally own these to see appreciation. A lot of times as a hedge against inflation because you think the value of the dollar is going to go down. Now look, I'm just a random guy on YouTube. I'm not a financial advisor. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never bind or trust a random guy on YouTube. But for me, my goal is cash flow. The bulk of my investments, not all of them, but the majority of my investments are cash flow focused because I love the idea of investing my money and getting paid every month, or every 3 months, or every year, because now I can see a real return on my money and I can see the cash in my pocket. And then when I get this cash in my hand, I can use this cash to pay for my expenses. I can use it to pay for my vacations. I can use it to buy me cars. I can use it to buy me whatever I want, because when I have the cash flow, that's money in my pocket versus appreciation is money on paper that says I've made money, but I don't actually make money until I sell. So now that you know the difference between being an active investor or a passive investor, you know the different ways you can get paid through cash flow and appreciation. Now you want to start thinking about which asset you actually want to invest in. And now this is where you got to start picking. If you want to be more of an active investor, you can start looking down the list here to see what's better for you. If you want to be more of a passive investor, now you can start looking down the list here. Now the first question might be, well, which one can I afford? And if you're starting as a passive investor, well, you can start with any amount of money in really any one of these. If you have $100 to invest, you can get exposure to real estate deals. You can also get exposure to ETFs, mutual funds, and index funds, although some mutual funds and some index funds will have minimums. Some of them might be a few $100s, otherwise they might be a few $1,000s. Likewise, with some syndicate and crowdfunded deals, they may have minimums, which could range from a few $100s to a few $1,000s to a few $100,000, depending on the deal. But there are opportunities for you to invest in all of these with small amounts of money. On the flip side, as an active investor, if you want to invest in real estate or you want to invest in a business, you're going to need more money. Tens of thousands, if not hundreds of thousands of dollars to start, but at least tens of thousands of dollars to go out and start investing in real estate and businesses. Yes, there are some opportunities to start with less capital, with less money, but at the very least, you want to have a few tens of thousands of dollars to get started here. With stocks or investing in startups or investing in commodities, you can start with as little as $100. So now you got to decide which one is right for you. Start with one before we start moving on to the next. Me personally, I have passive investments and active investments. I started off by investing in real estate. Once I got good here, then I started investing in stocks. Then I started investing in ETFs. Then I started investing in startups. Then I started investing in commodities. But I started with one because I wanted to be good at real estate first, and then I expanded to others. Now, let's talk about how do you actually execute your investments. I'm going to focus on stock market investing because that'll apply to everything else. But if you want to be a passive stock market investor, the first thing you have to do is find a platform that will allow you to invest passively into stocks. There are a lot of them out there. You can check out my affiliate. M1 is somebody who I use. If you use my link down in the description, we will get compensated. But there's a lot of platforms out there that will allow you to be a passive investor. And what this means now is you want to follow a strategy that I call ABB. Always be buying. The traditional way to say this is DCA, dollar cost averaging. And what this means is instead of trying to perfectly time the market, you set up a system. Ideally every week, if not every 2 weeks, if not every month. But it's a reoccurring system where money is pulled out of your checkings account and is automatically invested into your portfolio of funds. Whether it's ETFs, index funds, mutual funds, it does not matter. You have this portfolio of funds and now you set it and forget it. Always be buying. So let's just say you set a system where $100 is going to be invested every week. That's about $400 a month. Now $100 is pulled out of your checkings account every week and it's going to be invested into whatever funds that you have, and now you set it and forget it. You don't change it or turn it off when markets are crashing. You don't sell when you're in a recession. You don't panic when there's a lot of confusion and things going on badly in the markets. In fact, the only time you'd really change this is when you are going through a market crash or recession. You might invest even more money because that gives you the opportunity to buy more stocks at a discounted price. But you set it and forget it, always be buying. The way you win here as a passive investor is by being a long-term investor, meaning investing for years, if not decades. The way you execute as an active investor is a little bit different. Now, instead of just having a set it and forget it system, you want to start by researching. You want to start by researching market shifts. You want to find an opportunity that you believe is going to be worth more money in the future, or that you believe is going to become more profitable in the future. Now, there's a lot of ways that you can do this research. I mean, you can just start reading press releases. You can start buying publications out there. Like my team at Briefs Media, we have a product called Briefs Pro where we publish this type of investment research. So this is something that we do. But if you want to be more of an active investor, you want to be looking for this type of research. That way you can stay ahead of where the money is moving, and then you want to find some stocks that you want to invest in. Once you identify a few stocks, that's where you then want to do the financial analysis to see which stock you believe has the biggest upside. So you can see it starts to take more work, more time, more effort, but you also have more upside potential, because if you find a good investment before the masses hear about it, well, now you can see a big return. And that's why your research is so important as an active investor. It's the same thing in real estate. It's all about the research. Which location do you want to invest in? Where's the money moving to? Where's the population growing? Where's the demand growing? Because that's where you're going to see the biggest rental price growth, the biggest appreciation in the prices of the real estate that you buy. So it really comes down to your research as an active investor, because the better your research is, the better the opportunities you will find. Now, of course, it's not always guaranteed, but that's the name of the game. It's all in the research. And then when you find a good investment and you find a good buying opportunity, you find a good price, that's when you want to come in and buy. So it's not set it and forget it as an active investor. It's research and then come in and buy when you find a good opportunity. Now that you know how to execute, the final part is amplifying the process. How do you get better returns? How do you continue to improve your returns? And the way you amplify is going to keep this very simple, is by investing in your own education, investing in your own research, investing in your own knowledge, because that's what's going to help you get better. The mistake that so many people make is we assume that we know everything, but there's so much information out there. There's so much knowledge out there. And the way that you get better returns is by improving your knowledge. And if you can improve your returns, even by a little bit, it can change the trajectory of your finances forever. I'm telling you this from experience, because at first I never wanted to invest in my own education, but then I started reading books. As I started reading books, I started buying classes, then I started buying even more coaching, and I realized that there's a lot of education out there, and the more you learn, the more you can earn. And if you really want to amplify your success, you have to also invest in your own financial education. And this can start with some simple YouTube videos, then go out and read books and topics that you're interested in, then maybe go out and take some classes, buy some additional research, and then take action and see if that can help you improve your returns by finding better investment opportunities out there. Being wealthy means your investments are making you enough money to pay your expenses, so you don't need a job to pay your bills. The problem is most people will say, just invest your money into the stock market. But what if you don't know what stocks to buy? Or what happens if the stock market crashes and now your portfolio gets was cut in half and you were relying on that income to pay your bills. This is